Thank you guys very much for joining. Today, we are going to do a on-demand webinar. So once again, we are filming this, so there will not be opportunities to ask direct questions. But if you do have any questions, of course, you can email me at mark.lamonica1@morningstar.com. Today, we're going to talk about emerging markets. So I think it should be an interesting topic. So of course, how to invest in emerging markets, a couple of the picks that we have here at Morningstar for funds and ETFs. And then, of course, what are the big risks associated with emerging markets? But before we get into that, we need to go through our housekeeping items. So anything you hear today is general advice. I don't know anything about you, so I cannot offer personal advice. If you're over in New Zealand, you can get a copy of our FAP off of our website, morningstar.com.au. And also, the New Zealand regulatory authorities would encourage you to contact a financial advisor if you would like personal advice. All right, so as I said, emerging markets is the topic of the day. And I think there are, with some of the recent interest rate moves and also some of the market volatility, there are some interesting aspects to talk about with emerging markets. So let's get into that. Okay, so let's talk at a high level about emerging markets. So emerging markets traditionally have been uncorrelated returns, meaning that they have not moved in lockstep with developed markets and other asset classes, but they have been highly volatile, meaning they have bounced around significantly in price. Another important thing to think about emerging markets, and we'll get into this a lot today, is that there are very different economic profiles and development profiles for all of these different countries that are classified as emerging markets. So let's spend some time talking about that. So you can see over here that we have some of the top countries that are classified as emerging markets and the per capita GDP. And this, of course, is in US dollars. So what you can see is there are very large differences. So in many ways, some of these markets, specifically Taiwan, South Korea, probably resemble developed markets a lot more than they resemble emerging markets. And there are some index differences about what's actually considered an emerging market and not considered an emerging market. But either way, those countries are in very different stages of development than India, for example, or South Africa. So we do need to realize that emerging markets are in no way a group of very similar countries. It's really a historical classification that is used for a set of countries that were not at one point in time considered developed markets. But I think anyone who's been to South Korea or Taiwan knows a little bit about their economies, probably would not consider them emerging markets. So that's one thing that's important to think about. From a valuation level standpoint, emerging markets are, of course, cheaper than developed markets. Now, a very important thing to remember is they could be cheaper for a reason. And so traditionally just being cheaper is not necessarily what you were looking for. What you were looking for is, of course, a market that has the right risk and reward balance. So something to think about. Efficiency. We're going to spend a lot of time talking about efficiency. But emerging markets, for a lot of reasons, some structural reasons, some just investor interest, they are paid attention to a lot less than developed markets. So what does that mean? It means there's less professionals, less individuals, just less people in general investing in emerging markets. Some of that is because they may not be allowed to because of certain fund mandates. Some of it may just be interest. But either way, that less attention that's paid to them means that the markets are less efficient, meaning that values may deviate more from price than we would see typically in like US large caps or US big companies. So what that does is that, of course, creates opportunity. When there are those mispricings, there can be opportunity. So spend a little bit of time talking about what emerging markets are and what they're not, and compare them to developed markets. Then we can talk about some of the considerations that you should think about if you're investing in those markets. Okay, so I've taken two different ETFs. So you can obviously read what they are, but I took Vanguard MSCI International ETF. So this represents developed markets. Then we've got the iShares MSCI Emerging Market ETF. So that represents, of course, developing markets. So one important thing to note is obviously if we think about developed markets, they are dominated from a market capitalization standpoint by the US. So remember, if you're investing in these broad developed market indexes, you're really investing a lot in the US. We go over and look at emerging markets, not as pronounced, but we can see that we are investing a lot in China. So China makes up a very large part of emerging markets. China has not done well from a share market perspective over the past year or so. And that, of course, has held back emerging markets. But just remember that, as I said before, when you're getting very different economic profiles among the different countries in an emerging market index, remember what you're actually getting a lot of. You're getting a lot of China. And, I would say if we kind of look at China, Taiwan, South Korea, some of those top holdings, the top allocations in that emerging markets, all of them have gotten to the point where they are more developed, meaning that they are actually growing a little slower. So back when we used to see 10% GDP growth in China every year, well, that has slowly, of course, tailed off. So just remember that if your profile of an emerging market is a really fast-growing country or a country with a really fast-growing economy, that look at where this is actually allocated, and potentially you need to rethink that. We look at companies. So once again, we have the developed markets on the side. So developed markets are dominated by large US tech firms. We switch over onto emerging markets. What are we seeing? We're seeing a lot of large tech firms as well. So Taiwan Semiconductor, of course, is a semiconductor manufacturer. Tencent, Samsung, Alibaba, all once again kind of similar profiles of the companies that we are seeing over on our developed market indexes. So once again, very technology heavy and technology focused. So just remember that as well. All right, talk about how to access the market. So we have two different ETFs here in Australia that we give a medalist rating to. So once again, a medalist rating are our top ratings. So gold, silver, bronze represent funds and ETFs that we believe will outperform their benchmark over a full market cycle. So what you can see is two different bronze rated ETFs. So iShares MSCI Emerging Market ETF and the Vanguard FTSE Emerging Market Shares ETF. And interestingly enough, we go back here, we were looking at this iShares product, and you can see South Korea right there, number 3. One of the big differences between these two ETFs is that they actually track different indexes. One index, this iShares product is tracking the MSCI index. They consider South Korea an emerging market. And if we go down at this FTSE index, they do not consider South Korea an emerging market. So I don't know if that's too profound, but just an interesting piece of trivia, I guess, more than anything else. But realize that is going to have differences in the makeups and the companies, because we can see here, Samsung, almost 4% of this MSCI. Samsung, of course, is a South Korean company. That would not be in that other index. And South Korea, 13%. So that, of course, would not be in that other index as well. So just something to think about. It is a pretty large difference between the two of them. Over on the fund side, you start to see some gold and silver ratings, and we'll talk about why that is. But you can see some of our top rated funds that are domiciled here in Australia. One quick note, just so people can, and we'll talk about this in a second, it's Capital Group New World. So there's a hedged and unhedged version. So a hedged version simply removes currency risk. So you're only looking at the return of those underlying holdings within that fund, not currency. Of course, this unhedged version, that includes those currency components as well. Now we're going to get into how we think you should invest in emerging markets. So talked earlier about efficiency and market efficiency. So let's play this out a little bit. So the more efficient a market is, as we said, the more likely that prices represent value. So in those environments where price and value don't deviate as much, it of course is harder to beat an index. In inefficient markets where there is a large variance and can be at times a large variance between price and value, it is easier to beat the index. So the way that we measure efficiency, there is no real way of measuring it, right? Because remember, value, of course, is something that is in the eye of the beholder, but it's something that is calculated by analysts. There is no set value of a company. Price, of course, is observable. But the way that we measure this is we go and we look at what are the percentage of active managers that can beat their benchmark. So the higher the percentage of active managers that can beat the benchmark, we infer that the market is less efficient. So that means individual stock pickers have better chance of beating the market. So if we go and we look at lots of different categories of funds, so this is something called the Active Passive Barometer report that Morningstar periodically puts out, we can see diversified emerging markets. We're looking at long-term periods, so we're going to look at a 10-year period. So we can see 58% in low-price categories. We always think you should invest in low-price categories of funds. 58%, and those are funds with low fees, by the way, just to clarify. 58% of active managers were able to beat their index. So what does that mean? Well, it means that we believe there are opportunities for active management to beat the market. Now, that is why if you go back and think about that previous slide where we showed the different fund choices, you saw a couple passive ETFs and you saw a lot of active managers getting our gold rating. So we do think that this is still an opportunity for active management. All right, so let's talk a little bit more about some of the things you should be thinking about in terms of emerging markets right now. So one thing that's really important to note is that we, of course, are in a period where central banks are starting to raise interest rates. We're particularly seeing this in the US. We're also seeing a period, and these both correspond, we're also seeing a period where the US dollar has started to do pretty well. So we're recording this in mid-May. US dollar is doing very well. Federal Reserve in the US Central Bank is starting to raise interest rates. Now, traditionally, when this has happened, it has been a very bad time to invest in emerging markets. Sort of talk through why. In a lot of different cases, emerging markets, the governments of emerging market countries are unable to issue debt in their own currency. So a lot of them are actually issuing debt in dollars. And the reason for this is because one of the big risks around investing in emerging markets, at least traditionally, was geopolitical risk. And basically, at the end of the day, it's investors not trusting that country, their government and their central bank, to manage their currency properly and to maintain stability around currency. So they've actually told them, or they've actually said that the only way that they'll issue a lot of debt to them is in US dollars. So of course, an emerging market has no ability to control US dollars. They cannot print more dollars. They cannot inflate their way out of any sort of fiscal issue they come into where they're having problems paying off that debt. So they issue bonds in US dollars. That's a lot riskier for them, or potentially euros, some other foreign currency. And traditionally, when the US has started raising interest rates, we have seen the dollar strengthen, particularly if it's happening times when there is general geopolitical instability and there's a lot of risk out there. People sort of retreat to safety, which is the US dollar. So in those situations where the US dollar has gone up in value, and when we've seen capital flowing from emerging markets into the US because they're looking for the returns you get on those higher interest rates, things have not gone well for those emerging market countries. So of course, in the late 90s, we saw an issue with a lot of Southeast Asian countries. So beforehand, they were known as the Asian Tigers. They were doing very well economically. Well, the Fed started raising interest rates in the late 90s, and we saw a lot of turned into political instability, but a lot of huge economic impacts in those countries and big fall-offs in GDP. We've seen that a couple times since, so a couple other tightening cycles where the Fed has started to tighten. So it is something to be aware of, and we have seen a little bit of that so far, a country that not necessarily a lot of investors have on their radar, but we've seen the problems in Sri Lanka, seen the problems that they've had with trying to continue to provide power to the country because they've been struggling to go out there and purchase fuel at the end of the day to power the country. So we've started to see a little bit of that. So that is something that you should be aware of. Now, there's a lot of people there talking about how a lot of these countries that fall in this emerging market category are a lot safer now. They have higher dollar reserves than they have had before, and that there are reasons to be optimistic and lower debt levels. But it is just something to be very aware of when you're investing in emerging markets. Other considerations, so we talked a little bit about geopolitical instability. There's certainly sort of the rule of law side of things. We have seen problems, obviously, with Russia, an emerging market country. Investors investing in Russia have not had a very good time of it, obviously, with the ramifications from the war in Ukraine. So it is important to take those risks into account. More currency risk, so generally you can see bigger fluctuations in currency than you would see investing internationally in a developed market country. Obviously, you can take that away using hedging, but all different things to consider when you're investing in emerging markets. So certainly not something that we at Morningstar think should be a large part of your portfolio, but we do think in some situations there is an opportunity for you to put this as part of your portfolio, considering how uncorrelated those assets are, and considering potentially there's higher returns that you can get, particularly through active management. So that is emerging markets. If you have any questions, feel free to send me through an email at mark.lamonica1@morningstar.com. And thank you very much for joining.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.